and extraordinary in magnitude. Coming up, NVIDIA's blowout results fueling another rally in big tech. We're 25 seconds away from the opening bow this morning. Good morning. About to add some weight to this rally here today on the Nasdaq. The Nasdaq flying at more than 2% going into the cash open. Equity futures on the S&P 500 positive as well, by 0.85%. It's all down to one name in a moment. We'll talk about that one name in a moment. Let's see opening bow, switch on the board and get to the bond market. Yields look like this, higher by a single basis point on a 10-year. Up a basis point to 375.55. Big moves at the front end over the last 10 days. 10 consecutive days of yields higher, up another 7 or 8 basis points on a 2-year. 4.45. Coming with that, some dollar strength, euro weakness. Euro dollar 107.20, negative by 0.3%, and crude backing away as well. We're down by about 2.7%, 72.40 on WTI right now. About 20 seconds into the session, equities positive by almost 0.9% on the S&P. On the Nasdaq, up by 1.8%. One stock to watch at the open, NVIDIA. Shares hitting an all-time high after delivering blowout results on robust demand for AI processors. The company inching ever closer to a $1 trillion market cap. Alex Webb has more. Morning, Alex.
Morning, John. Yeah, really quite extraordinary numbers coming out of NVIDIA. The expectation from the market was that the current quarter revenue would be in the order of $7 billion. The company's now predicting $11 billion. That's a 53% increase on expectations. This is all really coming from the nature of the way AI is being rolled out. It is being pushed by Google. It is being pushed by Microsoft for their cloud businesses. If you are doing AI stuff in the cloud, they say you need then to have the AI chips doing it. NVIDIA makes those chips. Demand is surging, and that's why we're seeing this sort of eye-watering $200 billion pop in the valuation today.
Alex, is it the size or the immediacy of their ability to monetize this emerging trend?
It's the fact that it is immediate, but there is expectation for quite a long tail. At the moment, we're seeing Google and Microsoft do this for the bleeding edge applications. There is huge expectation that this will go into all sorts of compute power over the next few years. There had been some concern maybe that there wasn't enough capacity at the foundries that actually make these chips, the likes of TSMC. The fact that they are able to ramp up production on the scale they're telegraphing today suggests that that is not a concern. They have capacity to make these. The supply is there and the demand is clearly there too.
Adding some big market cap to this name in one session. Alex Webb, thank you, buddy. We're adding about 189 billion US dollars in market cap to one name in just a couple of minutes of trading off the back of all of this, and some big upgrades to the price targets that we've seen on the south side. Let's just go through them one by one. Citi, price target goes from 363 to 420. Piper Sandler, price target goes from 300 to 440. Barclays from 275 to 500. JP Morgan, look at that, 250 to 500. They've doubled their price target on this name. Just a monster move on Nvidia. Counts for about 5.5–6% of the Nasdaq 100. It's pushing the Nasdaq higher, pushing the S&P 500 higher by something like 0.6% this morning. It's almost boring to talk about anything else, but we've got to turn to retail. Best Buy topping profit estimates and maintaining its outlook unveiled back in March. The company's CEO weighing in on the challenging macro environment, saying customers are clearly feeling cautious and making trade-off decisions as they continue to deal with higher inflation and low consumer confidence. Kaylee has more. Hey, Kaylee.
Yeah, John, a 3% move here at the open doesn't actually seem all that exciting, but Best Buy may be excited to see a light, if you will, at the end of the tunnel. The first quarter, they did beat earnings expectations, but comp sales were down 10%, and they expect they will be down up to 8% in the second quarter. As you said, though, they do stick to their full year guidance, which is expecting a comp sales decline of no more than 6%, which suggests that they do expect that these declines will be moderating in the second half of the year. The company's CEO saying that they continue to expect that 2023 is going to represent the bottom in the decline of tech demand. Of course, they've really been struggling over the last year as consumers pulled back on discretionary spending for electronics specifically. And I would note analysts today sounding pretty positive after this report as well. Evercore ISI talking about how this is better than feared, considering they're sticking with the full year guidance. And our analysts here at Bloomberg Intelligence also note that operating margin seems to be moving in the right direction, which could help the company meet its profitability goals. So up 2.25% here at the opening bell. I tried my best to make that exciting, John.
Kelly, you did. Of course you did. Of course. I mean, 3% on Best Buy compared to Nvidia right now. Kelly, thank you as always. Let's stick with retail and the earnings from Dollar Tree, moving sharply lower after slashing its profit outlook. The CEO saying the following: while we're seeing early results from our initiatives, we're not immune to the external pressures affecting all of retail, notably the margin impact of elevated shrink and the product mix shift to consumables. Abby has more. Hey, Abby.
Hey, John, and we're now looking at the worst day for the shares of Dollar Tree going back to March of 2020, with this stock down about 16%, now negative on the year. Coming into today, it had been up 10%, but now a decliner. And it has everything to do with their profit situation. Now, sales of $7.3 billion, basically in line, but earnings of $1.47 missed by 4%. But more importantly, that's a year-over-year decline of more than 20%. A number of factors weighing here: tough comps. It's really, again, that profit picture that's worrisome, though. The shift in demand to lower margin food, legal costs from a rat infestation at a warehouse, an increase in what's called shrink. That's basically a fancy retail word for losses due to stealing. So the messaging is consistent here, though, with what we heard out of Walmart and Target relative to consumers being tight, but especially around the lower income consumer, forcing U.S. shoppers to go toward food that's less expensive and also spend less on discretionary. The new management team, John, really has their work cut out for them.
Stock down 15% right now. Abby, thanks for that. Let's turn to higher end retail. Ralph Lauren topping Q4 earnings estimates. The brand says it's still seeing strong consumer growth and acquisition despite declining revenue in both Europe and North America. Katie Greifeld has more. Hey, Katie.
Hey, John. Well, Ralph Lauren has pricing power. That's what you need to know. This was interesting. The brand increased prices by 12% for both the full-year and the fourth quarter. That helped to boost some of their earnings in the face of pretty sticky inflation, like you said, maybe some slowing sales. but let's get into some of the numbers because fourth quarter adjusted EPS came in at 90 cents. The estimate was for just 60 cents, so a big beat there. Net revenue came in at $1.54 billion. Again, the estimate was for about $1.47 billion. So some big beats there, really coming back to those price hikes, and the company saying there could be more to come. Specifically, it said that it expects to continue to be able to raise its average retail prices in the current year. You can see shareholders pretty psyched about that. Currently, Ralph Lauren up about 6.2%.
Katie, thank you. Just to bring the audience an update on what we're hearing from Speaker McCarthy. House Speaker Kevin McCarthy speaking to a US broadcaster, Fox News, a little bit earlier. This is what he had to say. Very difficult for Democrats to agree to spend less, although he did indicate that we've made progress on debt limit talks as of yesterday. He makes this statement that it's very difficult for Democrats to agree to spend less. Let's see if they can find an agreement. Right now, more broadly, this equity market is doing okay. As McCarthy says, we'll get this deal done at the end of the day. I think a lot of people still feel that way. Look at the bond market, Treasury yields higher by 7 or 8 basis points on a 2-year, 445. Just pricing in higher interest rates again, or rather taking out those rate cuts we'd priced for the second half of the year. As we do that, we start to bake in some dollar strength. The euro breaking down to 107.12. That's a new session low right now. Let's see if we break 107 on the single currency after coming that close to 111 several months ago. But this broader market, the lift we're getting is from one name at the moment, Nvidia, absolutely flying. Dan Hives of Wedbush had this to say. He read the following: Nvidia gave jaw-dropping robust guidance that will be heard around the world. For any investor calling this an AI bubble, we would point them to this quarter, cementing our bullish thesis and speaking to the fourth industrial revolution now on the doorstep with AI. That was well-known tech bull Dan Ives. Here's what else we've heard recently on Big Tech.
Technology is fantastic, but also, as we know, these biggest names are driven by the excitement for AI. The tech trade has been in the largest cap techs.
As you look out more, 6 to 12 months, we think tech will continue to be leadership.
It's not really the whole NASDAQ I like. I like these components which sits in the AI and the ChatGPT.
As rates have gone higher, tech has done better. Technology is still bolstered by CapEx. I think that a crash scenario is probably unlikely.
More bull market stability might help. Seems like tech.
We love technology.
Joining us now is Jordan Jackson of JP Morgan Asset Management. Jordan, I've got to start with this one. It's a difficult one for a lot of people. Are we on the brink of a melt up or a meltdown?
I think we're on the brink of a sideways market. I don't think that I'd like to see broader participation from the rest of the market. You certainly have continued to see big tech continue to hang in there. But I think more or less markets are pricing in this softish landing, right? This idea that the economy can avoid a recession amidst higher rates, amidst tighter banking conditions. But I think I struggle with sort of the fundamental story here. I still think earnings outlook still looks too optimistic from our viewpoint. And when I think about fundamentals and where the rate markets are currently pricing in their expectations for Fed policy, I struggle with the current valuation on the market as well. Obviously, the debt ceiling adds another layer of uncertainty. And so I think we're in store for a pretty sideways market. Now, this doesn't mean that big tech can continue to rally. I think that story continues to be much more of a micro story, right? Recognizing that tech continues to be fairly profitable, surprising on earnings, generally speaking. And so that suggests, maybe there's still a bit of legs. But as I look out maybe 6 to 12 months, I think fundamentally and maybe the valuation component becomes a little bit more challenging.
Well, Jordan, right now, though, to call that a micro story, it makes up a major chunk of the S&P 500. Can you really bet against that?
So look, from a price standpoint, right, when tech sneezes, the rest of the market is going to catch a cold. It's just because of the sheer weight. But again, we like to see when you look at the relative performance of the equal weight index relative to the S&P 500 more broadly, market cap weighted, that's severely underperformed. And that tends to, for me, I struggle with the durability of a broad, sustainable rally. And again, I think this will start to move towards a more macro story as you get further potential, at least less tightening from the Fed, more cautious potentially from the Fed, and that may be signaling a more severe recession. And I'm particularly worried about some of the stresses in the regional banking sector and that broadening out to the broader economy, leading into a recession. Remember, tech may be leaning a bit more quality these days, but it's still cyclical, right? And so if you get that recession, then again, I think you'll start to see some pressure in big tech.
Talk to me about what you think the relationship should be between what's developing in the bond market and equities right now, and how you would characterize how it's played out recently. Because right now on my screen, yields up, stocks up. Is that going to change?
Well, it's interesting. The risk-free market, just looking at the yield curve, is signaling that recession, right? It's signaling that economic slowdown. And when you look at credit markets within the bond market, they're also more or less in the camp of a soft landing, similarly with equities. With the exception of bank spreads that have really gapped out, the rest of the credit market spreads still look fairly tight. And so you're in this environment in which I think, the risk-free markets are pricing in that recession. Risk assets are not. They're still pricing in that soft landing, and it will be until we start to see some of the hard data come through that suggests that the economy is in fact weakening, that you'll start to see that macro story take hold, and I think you'll see a bit of volatility, choppiness in risk assets.
Jordan, where we are seeing weakness is abroad now. The data surprises out of Europe, ugly. Some of the data out of China, disappointing. Do you see any durable tailwinds in the rest of the world equity market story that so many people got bulled up on coming into 23?
So I guess my sort of out of consensus call is maybe some tactical upside to traditional energy and oil prices here. I think you're seeing domestic demand from domestic consumers coming from China fairly weak, and I think from that perspective, China is going to go into its old playbook and start to build out some of the fiscal stimulus and boost some of its fixed asset investment to try to boost some of its GDP numbers over the next couple of quarters. Also, if you look at sort of OPEC Plus, they've already announced some production cuts, and when you look at economies like Malaysia and Nigeria, for an example, they've been underproducing relative to those production quotas already, and that sets up a backdrop of lower degrees of inventory. And the last point that I would make is I've been somewhat surprised that the U.S. did not take the opportunity to rebuild up the SPR. And so we could be very well entering into a period in which demand sort of hangs in there, but the supply side becomes a bit of a challenge. And that could be a bit of a tailwind to oil prices.
Well, based on prices right now, they might have another chance. Jordan, thank you, sir. As always, Jordan Jackson there of JP Morgan. Crude right now back in by 2.8%, WTI 72. That's not the price you want, I know, so let's get it on the screen. Nvidia flying. 378 at the moment in early trading. We are higher by, what are we now? Up by about 24% on Nvidia right now. Coming up, Governor Ron DeSantis and his big announcement, not going to plan.
We're just trying to get it going because there's so many people. It's unfortunate. I'd like to never seen this before. Governor DeSantis for this.
That conversation up next. Governor DeSantis choosing to make his big announcement on Twitter.
Now it's quiet. All right, sorry about that. We've got so many people here that I think we are kind of melting the servers, which is a good sign. Thank you for putting up with these technical issues. I think we're definitely breaking new ground here. As far as I know, no major presidential candidate has ever announced their candidacy on social media this way. Certainly in a Twitter space. Steve, do you have a comment or question? I think you just need to unmute. If Steve can unmute, then we'll go ahead and ask him for a question. If not, we'll keep rolling here. All right, 3, 2, going.
I'm there,
all right,
guys.
sorry, Steve.
I'm there, guys.
Oh, there you go. All right.
Yeah, my bad.
Audio feedback glitches, accidental muting. Florida Governor Ron DeSantis looking to make the most of the difficulties.
We had a huge audience. It was the biggest they'd ever had. It did break the Twitter space, and so we're really excited with the enthusiasm.
Let's get to the team coverage. Bloomberg's Anne-Marie over in Washington alongside Mandeep Singh here in New York. AMH, how did that go?
Well, the New York Times called it a conference call from hell. And then, Jonathan, I know you at points were also listening in, and it was frustrating, right? Because you wanted to hear from Governor DeSantis, this highly watched candidate. Everyone's been waiting for him to make this announcement. It was supposed to start at 6 p.m., all these technical glitches. He didn't actually say he'd be running for president till 6:26 p.m. So obviously some frustration, I imagine, with those that were trying to listen in. They're spinning it as he, quote unquote, broke the internet. It remains to be seen what happens next. They were able to bring in about $1 million following that announcement. And right now for that DeSantis camp, it's going to be all about the fundraising. How much are they going to leverage all this, him entering the race, and potentially where this goes from here? Because, Jonathan, one key aspect that he definitely wanted to try to really come across yesterday is that he could be like Trump, but without the drama, obviously without really talking about the former president. The issue is the former president has doubled his lead on Ron DeSantis since March.
So bad it's good. That's one way of looking at it. So bad that it's good. We're all talking about it. The obvious predictable takes from a lot of people in the media, we've all read them this morning. You read some of that a little bit earlier, Anne-Marie. Mandeep, was it so bad it's good? For the platform, not for the candidate?
I think I've seen Twitter Spaces with over 1 million users, so clearly, the number of concurrent users caused a lot of difficulties for the platform. But to me, this is just, them not rehearsing this and not anticipating this kind of scale when it comes to this particular event. Look, I think people will forget, especially what they're trying to do with this is to target the younger demographic and, outside the linear TV channels that candidates typically use. So to my mind, they're going to use this more and more, and eventually they'll get used to it. But clearly, in terms of the viability of the platform, we are going to see more of this in this election.
Anne-Marie, we've got 18 months of runway, if he wants it, to carry on campaigning. To Mandeep's point, and we talked about this yesterday, these things can be forgotten pretty quickly. They feel terrible the morning after, but ultimately, what's the plan from here? What is the campaign going to look like? And what's the difference going to be between this candidate and the front runner right now, former President Donald Trump?
Well, I think one thing was clear yesterday. They wanted to do something a little bit different, something out of the box. What really struck me is I think this would have been the first candidate since FDR that had said, asking Americans to vote for him, saying, I want your vote, and was not on camera. But shortly after that, he did do an interview with Fox News. So you could see that they're definitely going to, at some point, also incorporate traditional media. And I think probably, Jonathan, that's where you're going to see this go. They're going to want to reach out to some more traditional networks after this interesting Twitter Space launch.
Interesting, it's one way of putting it. Here's something that's genuinely interesting. NVIDIA. I can't let you go, Mandeep, without bringing this up. The stock's up by 23%. Mandeep, what are you telling customers, clients at the moment, friends even, about what's developing here?
Well, so I think it's for a good reason. The fundamentals are strong. And anytime you see a company expanding their gross margin at this scale, it's a clear sign of pricing power. Everybody wants their chips. That's what's driving the demand. I do think valuation-wise, there's a lot priced in, but that's why, the results yesterday were a reflection of how good the demand is and how it is translating into their outlook.
Mandeep, as you said on Bloomberg Surveillance earlier, you could have said exactly the same thing last week And then we saw the numbers overnight. Just amazing. Mandeep, thank you. AMH, tremendous coverage as always. Down in Washington, outside the White House. Nvidia up by about 23% at the moment with some sector price action. Here's Abby.
A wild sector action, John. We have the S&P 500 up just about 0.5%, but a lot of sectors either up or down more than 1%. Sticking with Nvidia, we have the tech space up 2.9%, flipping between the best day since January or November of last year on that Nvidia and AI strength. But to the downside, we have energy down 2%, and then we have lots of the defensive sectors, utilities, healthcare, and consumer staples with yields soaring, investors not wanting those dividends, plus with Nvidia and tech who wants the safety. But let's stick with Nvidia. I know we would usually look at a sector here, but on the year up 158%. I got a little ahead over my skis the other day or earlier, John, but this is the best year right now since 2016.
Market cap 934 billion US dollars. Your trading diary up next.
Ready.
26 minutes into the session, equity still positive on the S&P 500, the Nasdaq. That's the price action. Here's the trending diary. Boston Fed President Susan Collins speaking from Rhode Island, 10:30 Eastern Time. Costco reporting earnings later. Plus, we'll get earnings from the Gap as well. US PCE inflation and UMich sentiment survey will round things out tomorrow. And looking ahead to next week, US markets, of course, closed for Memorial Day on Monday from New York City. That does it for me. Thank you for choosing Bloomberg TV and good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Thursday, May 25th. Here are the top market stories that we're following for you at this hour. Hike back on the table. Swaps fully price a hike now by the June-July meeting. After first quarter growth in spending gets revised higher and jobless claims fall, you got the two-year yield up by about 7 basis points. And Fitch strikes again, or first, I should say. The rating agency puts the U.S. on negative credit watch, and House Speaker Kevin McCarthy says we could get a debt deal at any time. Stocks prayed pretty well. And the $1 trillion club and counting, NVIDIA's market cap nears that $1 trillion mark after a huge sales forecast, crushing estimates on the AI boom. We're going to get the take from famed investor Kyle Bass, founder and CIO of Heyman Capital. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. I mean, incredible. This NASDAQ 100 rally is incredible, up almost 2%. Unlike real numbers, it's not just hype anymore.
Absolutely. You take a look at what NVIDIA is doing, it is sensational. What is interesting, Alex, is that it is also going up on a day when rates are going up. So that kind of idea that maybe this tech sector rally is rate sensitive seems to be disappearing. What I can't work out is this short covering? Were people really short NVIDIA? Is this people who were underweight chasing the benchmark? Is this FOMO? I don't know. There's all kinds of different things going on. We'll get to it in just a second. I think it's the story of the day. I appreciate the debt ceiling is out there as something that we need to be watching very carefully. We'll come to that later as well. We've also got to get to the housing data that is dropping onto the screen right now. Pending home sales month on month, absolutely flat, a little weaker than anticipated, and that takes the year-on-year non-seasonally adjusted number to negative 22.6. Alex, there is very little activity in the housing market. The new market is good. Everything else, absolutely quiet. Nobody's moving. Nobody wants to sell because they locked in those great rates. It is a market that feels in some ways broken at the moment. What is going to fix it? Well, you've just been talking about higher rates. That certainly will be taking us in a different direction.
But has it bottomed? So, I mean, I appreciate that we've seen the hit, and I appreciate that it's stagnating, but it's stagnating better than falling. And have we found a floor? Or are we going to see two different diverging markets, new versus existing, and then sort of how that then filters out? My question is, like, who is left to buy at this point except for new starter homes? And I don't know. We'll talk about that later on in the show.
Scarlett Olsen's going to be joining us from Zillow. We'll get a take on what is happening. We're going to do that later in the show. We've got a packed show. We've got a lot to talk about. Let's talk about this AI story. Let's talk about NVIDIA. NVIDIA is expensive, Alex. The question is it unique? Which takes us to the question of the day. What's the AI trade after NVIDIA? What do you want to do if you don't want to own NVIDIA at these levels, but you do want to get involved in the trade? Bloomberg's Alex Barinka and Mandeep Singh of Bloomberg Intelligence join us now to discuss. Mandeep, NVIDIA is expensive. Is it unique?
I think you have to look at the overall supply chain, right? So NVIDIA clearly has the chips that everyone wants, including the hyperscale cloud guys and the enterprise data centers. But what is enabling that? The supply chain of it is, you know, the equipment guys like ASML and Lam Research and Applied Materials, et cetera, as well as the foundries like TSMC that is actually making those chips. So if you look at the first derivative and the second derivative of how these chips are coming together, and obviously, cloud guys are deploying it at scale, so they will develop applications to monetize it, but it's like an end-to-end, it's a generative AI ecosystem. That's how I would like to frame it.
So Alex, what's your call on that? Like, is there another NVIDIA trade to be had?
I would actually look at NVIDIA's customers. So we have the obvious ones. You have Microsoft, you have Alphabet with its Google Cloud, obviously Amazon with AWS. The big cloud providers are a lot of the customers who are snatching up these NVIDIA chips. But I actually sat down a couple weeks ago with the head of Meta's AI infrastructure, and companies like that who will be very dependent on end use cases for consumers, integrating generative AI into their products, they are spending a ton redoing their data centers, buying up these NVIDIA chips and saying, hey, the foundational technology is really great, but let's actually make some money off of that and bring it into our products for consumers.
Okay, Alex with an E, let's talk a little bit about kind of what comes next. So NVIDIA is able to monetize this right now. What you're talking about is monetizing further down the road. When does everybody else get to monetize AI? Yes, the immediate supply chain around NVIDIA kind of works, but when you talk about the customers, they're not monetizing now. This is a trade that's further down the road. What kind of a multiple do I put on that?
Well, if you look at NVIDIA's stock, the multiple is incredibly high. This is a company that has 6 times the market value of Intel, the comparable, and half as much revenue. So we saw in the last earnings, I'll continue with the Meta example, Mark Zuckerberg, the CEO of that company, coming out and really talking about how they already are working on this stuff. That stock jumped up about 20% since that earnings call. So if you start to look under the hood at some of these companies, particularly the tech companies who are already working on some of this technology before we were all talking about ChatGPT, those are the ones that are probably first. But if I think down the road where we start to stretch the imagination of where AI gets integrated in, you can think about use cases in retail, you can think about use cases in warehouses and how you can integrate generative AI into that technology. So I think that's where this starts spinning forward. But for this moment in time, with investors also looking for a little bit of safety, NVIDIA seems like the safe bet.
Well, Guy, to that point, Cameron Kreis had a great piece out on the terminal that talked about the cycles that we've seen just in the last few years and how they're kind of fast and furious, right? Remember when people thought that the COVID pandemic was going to be structural in terms of some shifts that we were going to see, and then that didn't peter, and that petered out. And then you got crypto and how that was going to be the next thing. And I appreciate they were off the lows, but like that petered out to some extent. And how do we know if this is going to come to the same kind of cycle?
I always think about this through the lens of 2000. The internet was clearly going to change the world, and it has changed the world, but we had to go through a massive crash in order to figure out who was actually going to change the world. Mandeep, is that what we're going to have to see here?
Well, to me, the interesting dynamic here is all the hyperscalers, give or take, spend about $30 billion in CapEx every year. About $15 billion would be new CapEx. And right now, they're spending, 20 to 30% of their new CapEx on buying NVIDIA's chips. Now, do you think that's going to happen on a recurring basis? Every year, they're going to keep buying these chips?
Yep.
I think at some point, because NVIDIA's customers are so concentrated, the hyperscalers, and they like to vertically integrate, you will have that competitive aspect where they would want to do that in-house. And my sense is Microsoft is leaning more towards partnering with NVIDIA, Amazon not as much, and Google probably somewhere in the middle. So that's the dynamic you have to watch out for, is the customer concentration of NVIDIA and who will end up developing their own chip technology to rival NVIDIA. And it will take time. I don't think there is anything on the horizon right now. But an Apple, I don't think they're going to end up using NVIDIA. And so that is where you have to look at, what kind of a moat NVIDIA has and how long will it last.
Okay, so to that point, in terms of the rally that we're seeing now and what it's adding to the NASDAQ, for example, on a macro basis, like what worries you? Like if the Fed hikes again, like if there's a debt ceiling mess up, if we get in a recession, like what kind of dents that super near-term story?
Yeah, so...
Or nothing, I don't know.
Well, so right now it looks like generative AI is almost non-discretionary. Everyone wants to spend money on it, even if the IT spending is slowing down and they're cutting back in other areas. We saw Snowflake had a disappointing quarter last night. So clearly you could figure out areas where things are discretionary when it comes to IT spend, not so much on the generative AI side or buying these GPUs that NVIDIA is making.
Alex with an I, what I find interesting here is that this is clearly throwing this whole idea that we are rate sensitive in the tech space out of the window. At some point, maybe that does come back as well.
Well, Alex with an E, what do you think about that? Like at some point, does the macro kind of weigh on certain areas of tech?
We've seen tech lately be so sensitive to cost cutting and paying attention to these companies' bottom line. So as we look at where the general tech market goes in the future, particularly the large cap companies, they've been through this period of large cost cutting measures that folks have been really excited about. These are, though, companies that depend on innovation, and that spending will have to continue and probably ramp up into the next few years. And that comes back to this bet on executives and whether or not they're going in the right direction. Generative AI is, I agree, this non-discretionary idea that folks are focusing on right now, but how that actually plays out and how these companies start to make money off of it will really kind of start to probably drive some of the trades there, whether or not the general macro market is still seeing those big tech names as a place of safety.
Such a great conversation, guys. Thanks for setting us up. Alex Brink of Bloomberg and Mandeep Singh of Bloomberg Intelligence. Thank you all very much. Coming up, it is more on the question of the day. What is the AI trade after NVIDIA? Kyle Bass, Heyman Capital Management founder and Chief Investment Officer, will join us next. This is Bloomberg.
Debt ceiling deadline closes
Back
in.
and forth on the debt ceiling debate.
Kevin McCarthy says it's going to be on the floor next week.
Keep it tuned to Bloomberg for up-to-the-minute reporting.
Movement from the White House walked out of this meeting saying the White House was being unreasonable.
And first-hand analysis from the political and business leaders who matter.
The debt ceiling is potentially catastrophic.
We will not pass a clean debt ceiling.
They should just simply do their job.
Both political parties are guilty.
For continuing coverage of the debt ceiling standoff, keep it tuned to Bloomberg, your global business authority.
Well, over what period of time are the generative AI benefits that may inure to corporations? Well, that's an argument for why you could get margins re-establishing they got as high as 12%. Margins moved down to 11%. You could argue there could be 400 basis points, arguably, of margin expansion.
But I think we're using the wrong data point to evaluate the uptake of that, because 10 years ago, we didn't download apps. So I think that we really need to think about it and what are the benefits and the productivity enhancement. And maybe we start to see productivity improve.
As David Costin, Goldman Sachs Chief U.S. Equity Strategist, and Katrina Dudley of Franklin Mutual Advisors speaking with us on AI and how to think about it as an investor. So let's get to the question of the day. What's the AI trade after NVIDIA? Kyle Bass, Heyman Capital Management founder and Chief Investment Officer, joins us from Dallas. Hey, Kyle, great to see you. Answer the question. What's the trade after NVIDIA? Do you have one?
Yeah, you're putting me on the spot, and I'm not a great tech investor.
But you're a good shorter.
Yeah. I would just say that, look, the one thing that I see from the macro perspective is everyone thinks commercial real estate, is in the tank, and it's really just focused in the office market. When you look at the data center market, it is white hot. People that are developing data centers don't even get them developed before one of the FANGs leases it for 30 years. So I have a friend that has 13 data centers that they were developing all over the country, and in one phone call, did a $3 billion multi-decade deal with one of the FANGs. They just leased the whole portfolio. So data centers are white hot. NVIDIA is white hot. And as you know, we're building, TSMC is building both a 5 nanometer wafer fab and a 3 nanometer fab in Phoenix. We've got Samsung building in Texas. We've got Intel building in Texas. The U.S. is reshoring, onshoring this high-powered chip business, and NVIDIA is leading the way, first with their GPUs and their gaming chips, and now their generative AI stuff that is just, again, white hot. I wouldn't short NVIDIA. I think it just has a long way to run here.
When you talk about a long way to run, how should we be thinking about this? Is this a generational shift that we're experiencing here, Kyle? In 2000, we had to have a massive clear out before we figured out who was going to actually be top dog on the internet. Turned out to be Amazon and companies like that. Are we going to have to see something similar here? We're going to get a lot of people coming at this from different angles. How do we clear out and figure out who's going to be the winner, who's going to be the loser?
Yeah, again, I look at this from a different perspective, especially on the losing side. I keep reading everything from Wall Street telling me that AI and generative AI is going to be jobs positive. Mm-hmm. I just have an impossible time believing that. We've got 3 million plus, let's say, service workers that run cash registers or front ends of businesses in the U.S. We've got 3.5 million truck drivers. I can look through the businesses that I'm fairly certain we're going to see millions of job losses in. And I don't think you can train those specific people or retrain them into, let's say, the high-tech market. So I'm worried about the long-term job possibilities. I mean, just think about how many pilots are out there, and really, how many pilots are we going to need when we get real, let's just say, right now, the big planes essentially fly themselves. So we don't need the big crews that we've got. Anyway, I think about how many jobs are going to be put out of business as this gets.
So Kyle, so to that point, so you're thinking, okay, AI is this huge trend. It is a structural shift. It's going to have big implications for the job market, the economy, and productivity. Do you play that? Do you trade it? Is this like you mentioned, you go buy data centers? Like, how do you capitalize on this sort of evolving trend?
Yeah, I mean, developing data centers, owning public data center stocks, securities. I mean, that has given ChatGPT and the amount of compute that's taking on the back end. I hear that Microsoft and Amazon and the rest of the cloud providers are struggling desperately to keep up with the amount of compute that's going on with ChatGPT. And again, that's only going to grow exponentially as AI get stronger. Again, you're asking me tech questions. I honestly am not tech savvy. I'm sorry I can't add value there.
Okay, let me kind of create a Venn diagram where you may be able to add some value. Kyle, how much of a competitive advantage does NVIDIA give America?
Yeah, I mean, gives it a huge competitive advantage. And look, if you look at the chips market writ large, you've got TSMC and ASML are 90% of the most advanced chips in the world. You've got NVIDIA now blazing the trail in AI and generative AI. It gives us a huge advantage going forward. And again, we need to be thinking about these advantages, and not just the U.S. As you know, Guy, you're in the UK. The U.S. and our allies, let's say the rules-based order in the West, are starting to really think about how we can, China calls it containment. What we call it is defending our own national borders, our national security from malign actors. And I think, believe it or not, behind the scenes, we're working hard on, call it reforming the Quad and really getting close with our allies on this strategy going forward.
I know, Kyle, and I know you've sent a letter to the president talking about how you really want to protect U.S. interests, particularly from China, et cetera. How do you invest there, though? Like, do you need to short something in China to then capitalize on that? Like, what's the strategy for you?
Well, the thing that I could do to help listeners of Bloomberg TV and Bloomberg is to tell you, get out of China. Sell every single public security you have, every single private investment you have. There is no more risk reward that's positive. If you're a fiduciary, if you're a fiduciary of your family, or if you're an ERISA fiduciary, that you have no business investing in a country where you have no data. You used to have low fidelity data. The Chinese government cut off all macro level data. You've got no audits. No PCOB covered audits. You have Xi Jinping risk. You've got potential now Chinese risk of invading Taiwan. And what upside do you have from here? I just think you've got to basically sell China.
The upside from China was this idea that China was going to come out of lockdown, it was going to produce a lot of growth. And that growth was going to be a counterweight to a slowing Europe and a slowing United States. That doesn't look like it is showing up in whatever data we have right now. What is the read across from a China that is not going to deliver economically for the economies of Europe and the United States?
Right. Look, you don't see the China resurgence. If you look at demand for global commodities, again, you can look across the board, whether you're looking at copper, you're looking at oil, you're looking at everything that China buys on a daily basis hasn't budged. And if you look at their numbers from 2022, their LNG demand dropped 22%. Their payments across their payment systems were down 31%. If you guys buy that China grew its GDP when they were welding their citizens into their buildings, I have a bridge to sell you. So I think that I don't think China grew their GDP last year, and I think the concentric circles of their real estate markets are what's hampering them going forward. And again, we need to be thinking about how this world's bifurcating and focus on what we do best, which is adapting. We will adapt to these problems very quickly. It's not the end of the world like people say it is, and we are innovative, we meaning the West, and we will get together and we will innovate, we will adapt.
So Kyle, something that is maybe hampering any adaptation is the debt ceiling. Do you have a debt ceiling trade on right now?
I don't have a debt ceiling trade on other than I'm not short the markets, meaning, if you just look at the theater that's going on, McCarthy his goal has been to own the airwaves, and he's owned the airwaves. His risk has been, playing to the Freedom Caucus and the crazies on the right. And I actually think he's kind of been threading the needle properly. McCarthy and Biden, anything can happen when they meet. They're going to meet more often. And there are adults in the room, even though they're young staffers in the White House that think they can run this negotiation. I hope there are adults in the room that understand the depth and the implications of doing something as stupid as defaulting.
Okay, let's assume that they don't default, but they do agree some sort of a spending cuts, hiatus, whatever it's going to look like, Kyle. What is the impact of that going to be on the U.S. economy? Are we going to see a slowdown resulting from what is being negotiated right now?
No, I mean, I think the only thing you'll see out of this is a 1 to 1.5% spending cut on general government expenditures. We're going to spend on $4 trillion of revenues. I think we're going to spend about $5.6 trillion. We're talking about a 6% of GDP deficit. What you're going to see some sort of nominal headline grabbing number that, as you'll notice, when the defense appropriation people get involved with the left, they'll run it over the next time they negotiate. So this is all theater. This is all theater, guys.
Alex, if that's the case, then the Fed would appear to have more work to do. If the U.S. economy is not going to slow down, you look at today's data, you look at the claims data, you look at the GDP numbers we've just had, you look at all of the data that are coming towards us at the moment, it speaks to a very robust economy. If the government's not going to slow it down, presumably the Fed will continue to have to.
Yeah, Kyle, we're seeing the swaps market now priced in another 25 basis point hike through July. What do you think the Fed's going to do? How do you trade it?
I mean, look, there are a couple of answers there. I think if you look at the numbers, you look at credit card delinquencies and you look at the spending proclivities of each of the different socioeconomic strata in the U.S., it's dropping pretty fast on the expectation numbers. We saw the Foot Locker miss, so let's just say the lower end of the socioeconomic strata has received all their pass-through payments, and you're starting to see businesses suffer a little bit on the low end. On the high end, the excess, call it that excess savings that the Fed talks about being $1 trillion that still has left to be spent, that $1 trillion is in rich people's hands, and it's not going to get spent anytime soon en masse. So I think you're going to see the impact of 500 basis points of hikes hit our economy in the back half of this year. And then you think about the political economy. We're going to have a slowing economy. We'll have a slowing economy in the back half of this year. I think that's a given if you look at the forward numbers. And then as we go into 24 and an election year, I think you're going to see the Fed aggressively cutting.
So your suggestion would be no more hikes from here. How quickly do you think the Fed should cut? The market's just priced out the cuts for this year. You're suggesting that is a mistake?
Yeah, I mean, look at we paid, the United States government paid in 2020 about $500 billion of interest on our debt. We are going to pay close to, if not over, $1 trillion this year. 2 years later, we're doubling the interest we're paying on the debt, and that's largely due to the fact that we've raised the front end, 500 basis points. You can't keep rates at zero for over a decade and then move them 500 basis points and think you're not going to break anything. It just takes time. You've even seen some of the Fed governors refer to, we're going to be more data dependent going forward. We're going to see how much our hikes affect the economy going forward. So again, I don't know whether they hike another 25 or not. I really don't think that matters. What matters is how fast our economy slows down in the back half of this year.
Hey, Kyle, before we let you go, I just wanted to turn your attention to whistleblowers and sort of any advice you may have for them. Clearly, the SEC reversed itself on denying you whistleblower award. You were able to fight back. For the regular Joe, what's your advice to them?
Well, I tell you what, the SEC is supposed to have a whistleblower program in place to help to have the kind of the market participants, corporate, let's say the lower in the corporate side, turn fraud in. I turned a fraud in where one of my analysts found a Ponzi scheme, and the SEC actually just completely dropped the ball. They gave a non-scienter settlement with the management team, i.e. meaning leaving management in place. They brought fraud charges in a Wells letter, and the company settled. And the SEC settled with this company without even having a set of audited financials in place, and they left management in place. Then the DOJ and the FBI came in and put these people in jail for a collective 20 years on 40 felony counts. The SEC blew it. Now, I realize the SEC doesn't get everything right, but then they denied our award when we gave them an 80-page PowerPoint that was connecting all the dots for them.
Kyle?
The SEC's got to do a better job with whistleblowers. It's that.
On that note, we will leave it. Kyle, we've got to leave it. Thanks very much, Kyle Bass.
hour into a trading session. I got to be honest, there is one story, and that story is NVIDIA, and that story is NASDAQ 100. Bloomberg's Abigail Doolittle taking a look at that. Abby?
Yeah, tech really is outperforming. It's a day of divergences, Alex. If you take a look at the S&P 500, yes, it's higher, but up 0.5%. But take a look at the stocks, up 4.6% at its highest level since April of last year. Its best day since February, having everything to do with NVIDIA, that blowout outlook. We'll be taking a look at that stock in a moment. But take a look at these other indexes. It's not all green on the screen. You have the China Tech Stock Index here down 1.3%, and the Russell 2000 down 0.7%. So some uncertainty still lingering. One piece of that uncertainty, we have yields soaring higher. I was about to say creeping higher. That's just not the case. Over the last 10 days, this is the 2-year yield up 0.5% in 10 days. A very short period of time as investors weigh the debt ceiling drama, a little bit of the Fed in there, and now that we're past the bank turmoil, it seems as though we are pushing higher again. As for the big movers on the day, let's start out with NVIDIA. Its best day since 2016, up 25%, perhaps close to session highs in terms of the actual trading day. The quarter, the outlook, sales outlook for the current quarter, more than 50% above what it had been estimated to be. Dish Network up on the news that they may be, the Wall Street Journal reporting that they may be in some sort of deal with Amazon to deliver their wireless service, 5G. It could start as soon as June. To the downside, Dollar Tree, its worst day since March of 2020. Disappointing outlook there, especially on profits. Lots of different factors weighing, including the fact that low-income consumers are going toward the cheapest food available. And then Space, Virgin Galactic, down 5%, kind of all over the map. We are waiting, I think still waiting for a 6-person crew to go to the edge of space. A test flight coming out of New Mexico today, very crucial as to whether or not they're going to be able to start their space tourism business next month. Let's wait to see what happens with this stock, and hopefully it's a successful launch soon. And then finally, let's put all this together because it feels bullish today, but the last couple of days have been bearish. This chart we've taken a look at recently, it's the S&P 500 weekly. It is showing the reversal of last year's downtrend. The point I want to make, though, is a lot of times these waves, they have a lot of chop. This chart right now is pointing more than anything a sideways trend. I wouldn't be surprised, Alex, if we go back to 4,000 or below 4,000 before potentially going higher. But this chart, yes, I would say it's a sideways message right now.
All right, Abigail, thanks a lot. Really appreciate it. Abigail Doolittle, we do have some breaking news. Boston Fed President Susan Collins is commenting in some prepared remarks here, saying the U.S. inflation rate is still too high, showing signs of easing, but still too high, and that the rate pause gives some space to assess actions to date. At the same time, you had Fed President Barkin talking earlier in the hour, saying that labor demand in skilled trades is still crazy hot. This sort of all coalesces around the minutes. We're now pricing out some of the cuts. We're now pricing about one cut now for this year, and maybe pricing in one more hike as we get through the summer. Okay, speaking of eco data, you got pending home sales for April stagnating at the top of the hour. No change from March. You got high mortgage rates, limited inventory, curbing demand. For more, Skylar Olson, Zillow chief economist, joins us now. Skylar, is it a demand or a supply issue?
Oh, yeah. Well, it's a little bit of both in this picture, but I think to really grok what it means that pending home sales were flat over the month, real quick to just set the scene. So pending home sales, demand, right, affects affordability, absolutely was moving with mortgage rates. We saw that mortgage rate break in January, February, so pending sales come up, pending sales came down in March when we saw that mortgage rate spike. So here's the thing, we saw a bit of a mortgage rate relief if we compare March to April. So why were pending sales flat? Where was the recovery there? And it has everything to do with we're facing much more tangible limitations. So that supply picture that we're talking about, we just see much fewer homes listed during the month in April than we did pre-pandemic or certainly last year. We're getting tight again in housing markets.
So if we were to see a further rate rise from the Fed, Skylar, as is now being priced by the market by July, can you walk me through what effect you would think that would have on the housing market? Because it feels at this stage as if the Fed's struggling to get a handle on the housing market.
Absolutely. I mean, this is one of my biggest concerns, that if we do continue to see mortgage rates trend higher again, that's going to mean an even bigger pullback in volumes entering the market from those existing homeowners, right, who are locked in, ultimately holding on to very, very low rates and very sensitive to the fact that mortgage rates are even, up above 6, let alone, reaching up to 7. If we go too far up to 7, that does impact demands of affordability as well, and you'll see a more aggressive pullback on that side, and we could achieve balance. I think my bigger concern, though, is those low levels of new listings at a time when it's really important because we have such a massive fundamental demand going on. Put that in perspective, it's not just the size of millennial generation. It takes about 3% more of median household income to afford national asking rent right now. So you've got that first-time home buyer. They don't have that low rate. They're pushed forward. So this is a market that may, prices appreciation is returning, has, fairly returned certainly in April, and could return over the next rest of the year simply because that supply can't come.
I mean, Guy, I never miss an opportunity to tout my mortgage rate, so I will do so now. It is 2.75% for 30 years, and to your point, it would have to take like a significant job move or something huge, Guy, for me to want to leave that, because nothing, I mean, that's like a lot of money that I would have to be paying up for another house or apartment.
Even for the typical home in the U.S., that's like $800 more a month for you, right?
No, it's huge.
Okay, so Skylar, what lubricates this market? Is the only thing that lubricates this market, therefore, lower rates?
And time, so rates could come down and that could certainly, relax this problem. But, there's still fundamental reasons why people move, whether it's job loss, say if, we see some recessionary dynamics coming towards the end of the year, or divorces, getting married, these things push someone out of the low rate environment back into the more modern mortgage rate environment, and that will, eventually return us to normal. We are, though, watching mortgage rates, right? That is very much so driving the dynamics that we're seeing in housing markets.
And Alex, this is really interesting, but you bring up it would have to take a big job change for you to want to be able to change that rate, accept a higher rate, move to another area, take that job. You do wonder what impact this is ultimately going to have on the labor market. Now, the labor market is really tight right now. Is there a crossover between the housing market and what's happening in the labor market right now? People simply don't want to change jobs. They're not willing, they may be willing to accept things that they wouldn't normally do in terms of keeping their jobs. I appreciate the labor market is tight, so that maybe speaks against that. But there is usually a quite strong correlation between the two, and I'm wondering how one is distorting the other.
Yeah, that's a good question. Basically, if I move, it has to be because I got fired or I got divorced. It sounds like super grim. Like I definitely want to stay in my house. But Skylar, to the point, usually in a recession we would see job cuts. But now if we put in the tight labor market, and also some companies are just going to keep the labor because they had such a hard time hiring to begin with, does that wind up having a distortion also on the housing market?
Oh, interesting. I think right now the labor market question in terms of housing is still up in the air. I think, has it been over the past quarter maybe is a good, or even the past year? I think we've reopened, the remote work debate. Are people calling people back? Are they not? Yep. That probably matters a lot for those secondary markets, even on top of and more significantly than a cyclical labor market. I'm uncertain. I think there's so many things happening right now. Let's say I looked at a map of the U.S. and I was just looking at metro level home price appreciation, and I wanted to give you a story, right? I think it's a big mix. Some of it is price corrections, or to use a more modern vernacular, a market clapback, right, where it's just an adjustment about how fast it went. Others maintain that heat and move forward in appreciation. Some of the places that we saw the biggest price corrections are growing the most now. It's a real mixed bag, honestly.
If you were to look at what is hot and what is not right now, give me an idea of what is really selling. What is in most demand right now in the U.S. housing market? I appreciate it's regional, but give me a sense of what is really, really kind of what everybody wants.
Yeah, absolutely. I think no matter where you are in the U.S., if I was to break down the housing stock by, say, top tier, middle tier, bottom tier, that bottom tier is highly competitive. You're talking a lot more, listings selling over asking, short time on markets. That's a very competitive product as people seek affordability. But actually, interestingly, to kind of maybe inform even on thinking about that Dollar Tree numbers that you were presenting. If I were to look at manufactured housing, that typically would offer a lot of affordability, right? But generally that clientele, that buyer, lower income level, much more likely to be suffering from general inflation. So affordability is absolutely what people are driving towards. I think likely hesitating about older homes because you can't dip back in to a, say cash out refinance to cover an unexpected intervention that you have to make on a roof or, plumbing or whatever else. So it is a lot about the long run purchase.
Interesting.
That's a really good point. Scarlett, great to catch up. Always so insightful into what is happening here. Scarlett Olson, Zillow's chief economist, joining us from Seattle. Alex, hopefully no divorces, hopefully no firings. Those things would be bad.
No,
I'd like to avoid those if at all possible.
I want to keep that 2.75% mortgage rate, so let's make sure those two things don't happen.
Yeah, you could get offered an amazing job somewhere else. I would suggest that's not a good idea. I'm very happy. We should stay together and continue to do this. No divorces on this show.
No,
okay.
There we go.
There we go. Coming up, oil snapping its three-day rally after comments from Russia's Alexander Novak. OPEC will be meeting in around a week. Christian Malek, JP Morgan is going to be joining us next. Sorry, that rolled off the tongue. This is Bloomberg.
All right, oil down pretty hard today, over 2%. The price slide really beating up some hedge funds, like hedge fund manager Pierre Andurand. His main fund is down now almost 46% this year. He was banking on $140 oil. And all of this comes as the Saudi oil minister, energy minister, tries to really wring out the shorts.
The speculators, like anything in any market, they are there to stay. I keep advising them that they will be ouching. They did ouch in April.
All right, so joining us now is Christian Malik, JP Morgan Global Head of Energy Strategy. All right, Christian, that sort of comes as we get OPEC Plus next week. You were just in Saudi Arabia. What do you think we're going to see?
Well, Alex, I mean, there's always some narrative surrounding upcoming OPEC meetings. And having just been back in the King, as you say this morning, I can tell you this. Whether they decide to cut, do nothing, to add, I think know this, the highest common denominator for OPEC is to mitigate the downside and reduce volatility. And I think their track record says it all. I mean, they've proven correct with every move they have made, including the last. And somewhat, I sort of think, having just been there, central banks around the world could learn a thing or two from the Saudi Energy Minister, Prince Abdulaziz.
He is, though, talking about maybe wanting to inflict a little bit of pain on the shorts. If he wants to inflict a little bit of pain, Christian, doesn't he need to deliver a big cut? Because thus far, those kinds of threats have been fairly ineffectual.
Yeah, I think in the end, the short speculators will always be there. It's whether they're a dominant feature or whether they're sort of in the mix. I think oil is being used as a proxy for inflation hedging at some point in the past. Now it's being used as a proxy for recession. It's kind of been used as an asset class for all the wrong reasons. And the danger with that, guy, is that what happens is the volatility goes to max. The industry itself, which uses oil as a revenue line, doesn't invest because of that, and we see much higher prices in the future. So I think it's less around trying to remove the shorts. It's more about trying to reduce massive volatility in the future and massive inflation for consumers. Because in the end, if we don't see investment today because everyone's terrified because of the shorts, we're all going to pay for it later in much higher prices, where everyone loses in the end, especially the consumer.
Which is why it's so interesting to see, Guy, how the M&A is evolving. So Chevron earlier this week bought PDC Energy. This is a great deal for Chevron. It just helps them maintain kind of their production, but doesn't like grow. This is not like a transformational investment, yet it was over a $6 billion deal. Like, this is where we're spending our money now, rather than we're going to put a lot of money in a deep water, Guy.
So are we at the point now where it is better, it is easier to find oil in the stock market than it is in the ground? Maybe not easier, maybe cheaper, Alex.
I totally agree. I mean, you introduced the idea of volatility and removing the shorts, and in fact, the danger of all this is the WACC, the cost of capital of oil, so to speak, goes up. And so the incentive to invest and build massive production runways over 10, 15 years, especially with the ESG pressure, especially with emissions pressure, and especially shareholder pressure, is simply that you say, why would I bother? I'll just buy an asset. And the fact that this asset is bought, I mean, the productivity profile of this asset, I wouldn't say it's top quartile. It says it all. It says that we are now running short of shale volume growth in terms of investing, and I think it's very bullish. I mean, this year we put the super cycle on hold, but on the medium term, we think shale is going to plateau out in 3 to 4 years. And really, the only place the world can look for additional black oil will be OPEC.
So you did just have your energy outlook, or global energy outlook. It's the second time you've done that. Why have you pushed out the super cycle thesis? Is that demand driven? Like, what surprised you?
Absolutely. It is demand-driven. I mean, demand is king of the complex. We sort of have to sort of be humble when we do this work on analysis around energy shortages. But the reality is, and we coined the trilemma term back in 2018, and there's a report where you're introducing the energy quadrilemma. Now, what is that? Well, it's the generation of energy, the energy system to get the energy to the consumer, the government policy, which isn't consistent with fuel, and finally time. Energy transition is going to be a multi-decade, if not a multi-generation process. So I can be concerned about demand in the near term, but my major concern, having zoomed in on the energy system, is we're practically lack all materials, technology to get clean energy to the consumer in time. So you can generate as much as you want. And the danger of that is you see energy demand growth continuing after sort of this sort of 12 to 18 month kind of pause because of the recession and somewhat inflation. Then it roars back over the decade, and we have extreme energy shortages over the coming years and price volatility, especially in.
So, Alex, this is interesting because this takes us back to the question we were asking earlier on this week. Is Europe setting itself up for another energy crisis? A lot of the investments in renewables is going to the States, and you do wonder whether, therefore, the States has a lead. It's also got some of the gas, which Europe is going to struggle to get, and you do wonder whether, therefore, actually the epicenter of the crisis, if we kind of follow Christian's line, is going to be in Europe.
Yeah, that's an interesting point. And Christian, in your piece, you basically are looking at a $1.3 trillion CapEx call, but the majority of that comes actually from power generation. And I'm interested to see where you see that capital being deployed.
In fact, it's not only it's 1.3 trillion of incremental spend, which we're not spending. If you look at then where we can spend it, it's the metals, it's the technology around storage, it's the grid. Where does all that live? It lives in China. So we're basically massively dependent on China for the energy system. We can generate it in the West. We can produce solar energy and wind. But if you need the system, you need metals. So the energy transition itself is going to see a major energy demand shock, which we can't solve for because we need the energy and we're not producing it. And it all comes back to what energy do we have today to solve for it? What metals do we have today to solve for it? The energy, if it's oil, sits with OPEC. The system, if it's the materials, sits in China. So we're setting ourselves up in a way where, coming back to Europe, they can solve for the near term in terms of sort of either taxing the industry or subsidizing it through for the consumer. All we're doing is kicking the can down the road to major energy shortages in the second half of this decade, and so we're sort of sleepwalking into it.
So Christian, how do you play it, short and long term? When you can't get oil prices to get a bid, how do you play the oil majors? And then what do you do with like the BPs and Shells of the world, where investors just don't like their alternative investments as much?
Ultimately, you want to be playing it through being massive, I think, exposed to companies who can grow their energy, but the right source of energy on the right source of cash returns. So anyone that can grow volume growth in oil and gas, at the same time as being able to decarbonize through clever ways, through technology, at the same time as generating cash flow. You can't have one without the other. And I think you're right around the European majors. The risk is they're transitioning, but they're leaving the cash behind in terms of cash return. So if I look at that, who's got the greatest cash return? Who's got the most volume growth in oil? Who's got the ability actually to think about and solve for decarbonization? It's Total Energy, Shell, and then in the US, Exxon and Oxy. They have real oil volume growth and have committed and still have a reserves life with a runway. All the others, I mean, a lot of the others are struggling to grow.
Why don't I buy oil companies because they're oil companies and renewable companies because they're renewable companies? Why don't I just play it that way? Then I understand where the risk lies.
Exactly. Stick to what you know. And I think if there's going to be an energy shortage, you want to be playing where we short generation and where we are short system, because ultimately that's where the value of the arb is. In energy generation, we're short oil predominantly, therefore you want to be playing companies in that category. In the energy system, we're short everything to do with technology, in storage, in carbon capture. So you want to be long the companies who are delivering that technology, carbon capture companies that can deliver storage. So it's sort of like a barbell. But you've got to be very specific where you take that bet on the equities.
We didn't get to talk about crack spreads. I'm really disappointed about that.
You said it.
Christian?
You said it. I did not. He mocks me.
No jet lag from Saudi, so I'm thankful you haven't. I'm not sure I can.
Okay. Well, it was twice in a sentence the other day. It was incredible. Christian, great stuff. I hope you feel better. Get some sleep. Thank you very much. Christian Melek, JP Morgan Global Head of Energy Strategy. News that Italy is selling an ITA stake to Lufthansa. This is the old Alitalia. I think it's around 40%. We'll get some details in the next hour. This is Bloomberg. So Europe doesn't have much tech. The tech that it does have is doing very well today. Not Nvidia good, but still pretty good. So you've got technology up, you've got energy down. That leaves the stock 600 flat on the day. Thursday, we're going into Friday. We'll see what happens then at the end of the week. The tech we do have, as I say, having a good day. ASML makes the lithography equipment that Nvidia then uses ultimately to produce its GPUs, etc. ASMI is having a fairly good day. The European chip space is having a good day. Germany's in recession. That's what the latest data has told us. The final read on GDP confirming that. Not a big surprise. You're getting a little movement in bunds. The big move this week has been in gilts. That is where the real trade has been. Coming up on the European close, Barnum Wage is going to be joining us, UBS's chief strategist. This is Bloomberg.